Hi everyone, I'm Brandon from Basic Wisdom. Today we're going to talk through the characteristics of mutual funds. Specifically, we're going to look at a real-world example of the Fidelity Contra fund. So let's go ahead and jump in. Now, before we get started today, I do feel it's necessary for me to disclose that I used to work for Fidelity. So I'm a little impartial, and I really do like Fidelity's website. But by no means is any of this a recommendation or a solicitation. This is just informational and educational. When you first look at this screen, if you don't have a history or a background in finance, you're probably looking at this stuff and might be a little intimidated. It might look a little bit like a foreign language, but I promise all this stuff here has a purpose and it's really not that difficult. Finance is really just dressed up in language. It's never that terribly difficult to learn, at least the basics. But the language is what really prevents us from understanding and from really feeling like confident with this material. So my goal today is to really kind of remove the veil and to teach you what all this stuff is on this page. So at the top left of the screen, we have the Fidelity Contra Fund. That is the name of the fund, and almost every fund out there has two things in it. One, the name of the company that runs it, so Fidelity, and two, it usually has some kind of wording in there that relates back to what the fund does or what its goals are. Now, the Contra Fund doesn't really tell you right away what it's investing in, but the name comes from contrarian. This is a contrarian fund. And if you were to look into the prospectus of this fund, it would say something along the lines of this fund searches for securities where their value is not fully realized by the markets. And that is just industry jargon for we're trying to find something that's cheap that shouldn't be cheap. Now, going down from there, you'll see a section that says Morningstar Snapshot. Now, Morningstar is actually a testable topic. You don't need to know a ton about it, but Morningstar is a company, and it's a service that provides a ton of information to investors on mostly mutual funds. Now, what it's mostly known for is its rating system. And as you can see right here, there's a 5-star rating system. As you can probably tell, the more stars you have, the better your fund has performed. So this is a fund that Morningstar rates on a 4 out of 5 scale, which in reality means that this fund has beaten most of its competitors, but there's a good handful of other funds out there that are doing better than it. So it's performing on an above average rate. You'll even see a little bit more of that as we kind of go to the right-hand side of this Morningstar snapshot. If we look at the return section, we can see the returns are above average. And if we keep going to the right, we'll see expenses, which represent the cost of running the fund. Of course, there's a bunch of stuff that happens behind the scenes, like you got to pay the fund manager, you got to pay the team of traders that invest the money. There's a lot of cost to running a mutual fund. Generally speaking, you want to have a fund that has a low expense ratio. And we can see that, this fund is not the cheapest one out there, but it's not the most expensive either. And lastly, Morningstar categorizes this fund as a slightly above average risk. And we can expect at least that type of rating with most stock-based mutual funds. As we know from our materials, investing into equity is definitely more on the risky side than, say, when we compare it to fixed income securities like bonds or CDs, etc. Now, let's go ahead and go to the right. Performance. Performance will tell us what our return is based upon a specific time frame. Now, in your materials, you'll learn that when you give the returns of a mutual fund to your client, you can never be selective. It can be really deceiving if you're giving your client or customer just a small snapshot of time. So for instance, if a fund did terribly 11 out of 12 months and you just showed your client the 1 month it did well, that's deceiving. You got to give them the full picture every single time. So it's June 2018 right now, and we've been in a bull market essentially since basically mid-2009. So we can expect that most mutual funds that are investing in stock to do pretty well, and this fund has done well. 22% of the last year, 14% of the last 3 years, and those are annualized returns. So not bad. We can even go a little bit further if we take a look at the chart right below that. And Fidelity always has a chart that will show you the hypothetical growth of $10,000. Now, the point of this chart is to show us if we had invested $10,000 10 years ago, how big our account would be today if we just didn't touch it. We just kind of set it and forget it. We can see, just by looking at the lines visually, we can see that the purple line is the Fidelity Contra Fund, the blue line is the S&P 500, and then the orange line is large cap growth, which is another way of saying the average of other funds out there, they're basically doing the same thing that the Contra Fund is doing. And we can see, by and large, the Fidelity Contra Fund has pretty much done better than both for the majority of the 10 years. This is a pretty good indicator that the fund manager and the team running this fund is actually doing a pretty good job. Let's go ahead and go to the left-hand side under details. And this is where we're going to see a lot of testable material here. The first thing listed is the Morningstar category, which is just a categorization of this type of fund. Large cap is typically any kind of company that is above $10 billion in market cap. And once again, that is 10 billion, not million, 10 billion. This is a fund that invests into big companies. Growth in a nutshell basically means that we're trying to find things that will grow faster than the general economy or than the average company out there. Fund inception was 5/17/1967. That's when the fund started. So yeah, this is an older fund. It's been around for several decades. Below that, we will see an expense ratio. Now, Fidelity does have a gross and a net expense ratio. Do not worry about the differences in terms of what you need to know for the test. That might be a little bit more applicable real world, but as you can see, both numbers are pretty much the same. The expense ratio essentially measures the cost of the fund to run itself. For every $100 that this fund makes on its investments, 74 cents goes to pay for the cost of running the fund. So, that might not seem like it's a ton, right? Like 74 cents, out of $100, that's nothing. But remember that this is an annual number. So this doesn't just hit once and then it's gone. For as long as you're invested in this fund, it's going to take some kind of money from the return to run itself. And as we saw before, this expense ratio is not the highest. I've seen expense ratios in the 2-3% area. That would definitely be considered high. I've also found mutual funds on the other end of the expense ratio spectrum, sometimes at like a 0.10 or a 0.18 expense ratio. Basically, this is a below average expense ratio. Not terrible, not great, just somewhere there kind of on the lower end of the middle. Now, below the expense ratio, we're going to see something that is very, very, very testable, which is the net asset value, the NAV. One thing that you're probably looking around for that you might not be seeing is the POP, the public offering price. Whether you're taking this Series 6, 7, 65, whatever test, if it's talking about mutual funds, it's going to talk a lot about the NAV and the POP. Now, think about it for a second. Why does this fund not have a POP listed? Well, this fund does not have a sales charge. And whenever there's not a sales charge involved, there is no public offering price. If a public offering price is disclosed, the assumption is that there's a sales charge associated with the fund. And there is no sales charge associated with this fund, so we buy and we sell the shares at the NAV, which the net asset value per share is $135.78. Now, the rest of the things on this detail section are not necessarily testable. I don't think you'll see them on the exams that you're taking. All right, let's go ahead and scroll down here to the next section and kind of take a look at a few things here. Now, at the top left of the page, we're going to take a look at something I find very interesting, which is the top 10 holdings of the fund. This will show you where most of the money of the fund is invested. And in fact, we can see 37% of the portfolio is tied up into the top 10 holdings, that's a huge chunk. Well, we got Facebook, Amazon, Berkshire Hathaway, Microsoft, Google, etc. These are big companies, as you can see, and that kind of goes back to the purpose and the goal of the Fidelity Contra Fund. And you can even look a little bit further down below that. 351 holdings as of 3/31/2018. I know that's a little bit of a lag given that it's June 2018 right now, but I think this is important to kind of look at for diversification purposes. If you buy one share of the Fidelity Contra Fund, you are in effect buying a little piece of 351 different investments. It's pretty big. So that's why a lot of people will say that you get instant diversification with a mutual fund. In a way, you do. To the right of that, there's a whole list of similar fund picks from Fidelity, and not a ton there to look at. To the right of that, we'll find some information on the fund manager, which is basically the leader of the fund, the person who's kind of orchestrating everything. Now with a $128 billion fund, Will Danoff is not doing everything. In fact, he has a whole team of people that basically does research, do trades for him, etc. He's basically the ringleader of the operation, though. He's been running the Fidelity Contra Fund since September 1990. That's crazy. So it's June 2018. He's been running this fund for almost 30 years, which is insane. A common question I get, even though I'm probably not the right person to ask here, is how do I become a fund manager? And I can tell you that there's two traditional paths, and then there's probably a bunch of creative ways you get in there. But Will Danoff probably took the most traditional path, which is he goes to Harvard and he graduates with a BA in 1982. I think his BA was in finance, and then he goes on to get his MBA from the Wharton School of Business in Pennsylvania, which is known as one of the best, if not the best place in the world to get an MBA from. So basically, he went down the Ivy League path, and he went to work for Fidelity soon after, and within 4 years of getting his MBA, he was running the Fidelity Contra Fund, and he's still doing that today. The other common way that people get into the fund management world is through a certification called the CFA. It's a Chartered Financial Analyst certification. If you're really interested in it, look into it, but it's a difficult test. It'll take you at least 2.5 years to make it through everything, probably more. Now, at the very bottom of the page, it's going to show us kind of a spreadsheet version of that chart that we first saw in the beginning, which will basically show us that the Contra Fund has done better not only than the average fund out there that does the same thing it does, but it's also done better than the S&P 500. So just some numbers there. And the last thing that we'll look at here at the bottom left is the fund overview, which will kind of give you a big picture idea of what the fund is doing. It never really goes into specifics here, but we can see under the objective that this fund seeks capital appreciation, which is another way of saying we're trying to buy stuff at a low price and sell it at a high price. And isn't that finance in general? Buy low, sell high? Well, that's the only thing that this fund is focused on. Now, you might be wondering what other funds might focus on that would be different. Well, if you're invested in a fund that is more of an income fund, maybe you're not focusing on capital appreciation, but you're focused on receiving dividends or interest from the investments in the fund. And more income-focused funds will have different language than capital appreciation. We'll say something like seeks income from investments, something like that. Under the strategy, it kind of talks to the, remember how I talked about the name Contra Fund, contrarian? Well, the Contra Fund is investing in securities of companies whose value FMR, which stands for Fidelity Management Research, you can just think Fidelity. It's investing in securities of companies whose value Fidelity believes is not fully recognized by the public. Investing in either growth stocks or value stocks or both. So that's a confirmation that this fund, although it's categorized as a large cap growth fund, there are some value aspects to this fund. And like I said, we'll talk about the big differences between growth and value in a different video. And then below that, it gets a little bit into the risk of the funds, talking specifically about, if you're investing in stock, yeah, you're going to see a lot of fluctuations, especially in a more volatile market. But it's going to talk a little bit about those risks and what to expect in investing into a fund like this. Now, I know I didn't go through every single aspect of mutual funds in this video, but I hope the ideas I shared in this video help provide you a little bit more context for what a mutual fund is actually like. I will definitely be releasing more videos that focuses on what these investments look like in the real world. So subscribe to the Basic Wisdom channel if you'd like to get access to that information as soon as it's available. If you'd like some more information on how I can help you with your upcoming financial licensing exam, go to basicwisdom.net and click on the tutoring tab. You'll find a lot more information there about how I can help you, the services I provide, and some additional resources that will help you pass on the first try. Thanks for watching, and I'll see you next time.